Hey everyone, and welcome. Today, we're going to dive into something that can feel, well, super confusing, the stock market. But our goal here is really simple. We're going to translate all that jargon into language you can actually understand and use.
Okay, so you've definitely heard this one, right? Someone on TV says we're in a bull market, and everyone just kind of nods. But what on earth does that actually mean? Or maybe you've stumbled across something that sounds a bit more technical, like a PE ratio, and your brain just kind of shuts down. Like, nope, that sounds like a math test I didn't study for. It's these kinds of terms that make investing feel like it's for somebody else.
But here's the thing. It really doesn't have to be that complicated. The stock market isn't some secret club. It just has its own unique language. And today, we're going to be your translators. All right, so where do we even begin? Let's start with the absolute basics. The single most important building block of this whole thing, the stock. You know, a stock sounds fancy, but at its heart, the idea is incredibly simple. It's just a tiny piece of ownership in a business. So if you own one share of Apple, you own a tiny slice of Apple. That's it. You're literally a part owner. How cool is that? Now, not all stocks are created equal. There are really two main flavors you'll hear about. Most of us deal with common stock. That gives you a say. You get to vote on big company decisions. Then there's preferred stock. With that, you usually give up your vote, but, and this is a big but, you get put at the front of the line to get paid when the company shares its profits, which are called dividends.
Okay, so where does all this buying and selling actually happen? It all goes down on a stock exchange. Just think of it like a giant, super organized marketplace. But instead of fruits and vegetables, people are trading these little pieces of companies. The most famous one, of course, is the New York Stock Exchange.
So, owning one stock is awesome, but the real magic of investing starts when you begin building a collection. Let's talk about how that works.
And that collection has a name. It's your portfolio. It's just a fancy word for all your investments. Every stock, every fund, all gathered together in one place. It's your personal financial team. And here's the best part. You don't have to spend all your time handpicking every single stock. You can actually buy pre-built collections. A mutual fund is like hiring a professional manager to create a whole basket of stocks for you. An ETF is similar, but it trades all day long, just like a single stock. And an index fund is maybe the simplest of them all. It doesn't try to be clever, it just buys all the stocks from a major market list, like the S&P 500.
Okay, so now we know what a stock is and how to buy a bunch of them at once. But which ones? What kind of stocks should you actually be looking for? Well, that really depends on your style.
This leads us to one of the biggest philosophical debates in investing. Are you a growth person or a value person? A growth stock is a bet on the next big thing, a company that's expanding like crazy. A value stock is for the bargain shoppers out there. It's about finding a solid, maybe overlooked company that seems like a really good deal right now.
And then you've got the heavyweights, the tried and true champions, blue chip stocks. These are the household names, the massive, stable companies that have been around forever. We're talking about the giants of the industry. They're known for being reliable.
You'll also hear companies get sorted by size based on something called market cap. And don't let the term scare you. It's just a simple way of saying, what's the total value of the whole company? As you can see, you've got your large caps, the giants worth over $10 billion, mid caps in the middle, and small caps, which are often the younger, faster-growing companies.
All right, let's zoom out from individual companies for a second. There's a whole different set of words people use to describe the general mood of the entire market.
And this is where we meet the market's two famous mascots, the bull and the bear. A bull market is like a charging bull, strong, confident, and pushing prices up. A bear market, think of a hibernating bear, hunkering down, pessimistic, with prices falling. It's all about the overall direction and feeling in the air.
So you might be wondering, how does anyone know if the market as a whole is up or down? I mean, there are thousands of stocks. Well, we use something called an index, and the most famous one is the S&P 500. It just tracks the performance of 500 of the biggest companies in the US. So, when the news says the market was up today, they're almost always talking about the S&P 500.
Okay, let's talk about the market's personality. Is it calm or is it freaking out? That's volatility. I love this analogy. It's basically the market's heart rate monitor. When volatility is high, that line is jumping all over the place, big swings up and down. There's even a fear index called the VIX that measures how much anxiety is out there.
Okay, we're going to get just a little bit more technical here, but I promise no crazy math. Let's talk about how investors actually figure out if a stock is worth buying.
So one of the first things people look at is called earnings per share, or EPS. And it sounds way more complicated than it is, really. All you do is take a company's total profit, you divide it by all the shares out there, and boom, that's how much profit belongs to each individual share. It's a key health metric. And that EPS number lets us ask a really important question. Okay, for the price I'm paying, am I getting a good deal on those earnings? That's where the PE ratio comes in. It helps you figure out if a stock is expensive or cheap compared to its own profits. Now, a high PE could mean everyone expects it to grow like crazy, or it could just be way overpriced. A low PE might be a hidden gem, or a sign of trouble. It's a clue.
So once you know all this stuff, you have to decide what kind of investor you want to be. And really, it boils down to two main camps. Passive investing is a set-it-and-forget-it strategy. You buy a broad fund and just let it ride for the long haul. Active investing is the total opposite. That's where you try to be a stock market wizard, picking winners and timing your moves perfectly. And let me tell you, that is way, way harder than it looks on TV.
Okay, so let's bring this all home and talk about what really matters for most of us, playing the long game and building a solid strategy. For long-term success, there are two golden rules, two concepts that are absolutely your best friends. First, diversification. You know this one, don't put all your eggs in one basket. Spreading your money around helps protect you. Second, dollar cost averaging. This just means you invest a set amount of money regularly, no matter what. It takes the emotion out of it and helps you buy more when prices are low and less when they're high.
So there you have it. We've cracked the code. What once might have sounded like a foreign language, bulls, bears, PE ratios, is now just vocabulary. It's not a wall keeping you out, it's a toolbox you can use. So the only real question left is, now that you speak the language, what story is the market going to tell you?